Talk about the home loan demand, which has recovered. What exactly are the factors that are aiding this momentum? Are the demand trends looking sustainable? Joining in on the show, we've got with us Mr. Keki Mistry, is the Vice Chairman and CEO at HDFC, to decode that and lots more. Mr. Mistry, thank you so much for taking time out. Now, it seems like the demand for housing is very stellar, back to those pre-COVID levels. There have been a number of government initiatives as well, like stamp duty cuts, that seem to have helped. But in your view, what would you attribute this to in terms of the broad factors? And do you think that this is a sustained demand that can keep going?
I think what's helping the sector, honestly, and this has been my view for a very long time, that this is really one of the best times to buy a house for a variety of reasons. Firstly, interest rates are probably as low as they will get. Probably. I mean, I personally don't think there is much scope for a rate cut going forward. That's number one. Number two, most states have done something or the other to incentivize people to buy a house in the expectation or in the belief that by giving a boost to the housing sector, effectively you'll give a boost to all the core sectors in the economy: cement, steel, paint, power, and all the ancillary industries associated with housing will get a boost. Then also is employment creation. Housing creates a huge number of jobs. So therefore, different states have done different things. But for example, if you look at Maharashtra, which houses Mumbai, which is the largest branch in terms of growth, in terms of retail business. And it also, Maharashtra also has Pune, Nagpur, Nasik, three other relatively big branches. Mumbai, in Maharashtra, the stamp duty rate has been reduced from the original level of 5% to a level of 2%, provided the registration of the property is done before 31st of December, and then it becomes 3% if it is done from January to March, and then post-April, it reverts back to the original level of 5%. And thirdly, what we notice today, and when we talk to developers, they tell us that any customer who walks into their site in these times means he's a person who's definitely very, very interested, and they would try and complete the sale with him. If it means giving a little discount or a 3, 5, 7% discount is something we've heard quite often. So a combination of these three things has made housing probably more affordable today than it has been for a very, very long period of time. Also, you must remember that in the last 4 years, or close to 4 years, property prices in India by and large have not gone up. If anything, they may have marginally come down. And therefore, in the context of all these facts, this becomes the best time to buy a house.
Mr. Mistry, how are you analyzing the entire lending environment? Because it does seem that things on ground are improving. Is this increased demand translating well in terms of disbursements too?
All right, so let me start with the pandemic. When the pandemic and the lockdown happened in March, we told investors at that time that we expect that with every passing quarter, the growth will pick up and each quarter will be better than the earlier quarter. And we believed at that time that by the time we come to the January to March quarter, we should be about 90% of the normal Jan to March level. The growth has come in significantly faster than what we had originally anticipated. And we've been seeing with every passing month that the demand has kept increasing. And this we've been seeing right from the month of June onwards. So June was better than May, July better than June, August better than July, and so on and so forth. If we look at September, for example, I'm giving you only numbers which are in public domain. So if you look at September, our individual loan disbursements were 11% higher than what they were in September of the previous year. If we look at October was actually more than 30%, almost 35% higher than what the October of 2019 was. But let me add, there is a caveat to that, which is that the October 2019 number was a little low because we had Diwali in October last year as opposed to November this year. And usually at that time, there are holidays and the growth tends to slow down slightly. So if we normalize the growth, if we look at the full quarter, October, November, December of 2019, and take an average and compare that to October of this year, then even the growth would have been 22%. Now, 22% growth over the previous year's October, to my mind, was a very big growth. So growth is coming back, it's translating into disbursements, and we are seeing this almost pan-India. barring maybe one or two locations where the growth has not picked up. But barring that, most other locations, growth is come back to levels. And just in housing, seeing even this, seeing this trend in the industries. Maybe industries like hotels, hospitality, airlines, these three sectors continue to, have some degree of stress. But by and large, most other sectors, the growth has almost come back to pre-COVID levels. And in some sectors, is better than pre-COVID.
Okay. Mr. Mistry, we're in a downtrending interest rate regime, of course, and we've already seen quite a substantial decline on those rates. Is there further room for cuts? Because, for how long do you think we can ignore any, uptick in inflation, which is also bound to continue to move higher?
The RBI's expectation, from whatever I have read, is that the little spike that we've seen in inflation in recent times is temporary, and they expect inflation to moderate in the quarter ahead. So let's believe that, let's expect that is probably what will happen. But having said that, once growth picks up in the economy, it may be 2 quarters later, it may be 4 quarters later, I don't know how, with a lag it will come. But when growth picks up, you will start seeing some degree of inflationary pressure coming through. So whilst the current levels might be temporary in nature and inflation would come back to normal levels in a couple of months, at some point of time, the higher growth rate that we are seeing could translate into higher inflation. That's something we will have to wait and see. Look, all this, what I'm talking about, growth, optimism, all of that is real at the moment. But there is a risk to this. And the risk is the occurrence of a second wave in India, which is something we cannot at this moment predict or expect. But if we were to have a major second wave coming through in India, like we've seen in some of the European countries, then again one will have to reevaluate the situation. Okay.
Given the rising competition from banks as well, home loan rates, could we expect consolidation, at some level within some of the larger banks, considering they're already gaining market share? And also, do you see a further increase as well coming in financing to the residential segment?
To be fair, there is competition in the market like it is in all good times, but the competition is not unreasonable. The competition is fair, and there is no one who's undercutting or doing anything which would create any long-term problem for the sector. So there is a certain amount of competition, but believe me, it is no more than what it used to be in the pre-COVID levels. Market share, I think some of the NBFCs have slowed down, particularly post the ILFS crisis, both HDFC and maybe a couple of months, but again, market share during that period.
Mr. Mistry, the real estate sector as well has seen quite an improvement in growth in residential as well as commercial. How has been the scenario for commercial real estate in terms of, if you could tell us which are the segments that are showing you growth, and do you think that we can see this momentum continue into FY22 as well?
First of all, to answer your question on commercial real estate is as active and as buoyant as the residential market. Initially, there were a lot of concerns, particularly in April, May, when everyone was talking of work from home and offices would not be open and things like that. But by and large, most offices are open wherever given under the LRD facility, which is lease rental discounting facility. There are no delays. People are paying their installments, or people are paying their rent on time to the landlord, and through that, the lenders are getting the money. So commercial real estate is also thriving, for the same reasons. The reasons being low interest rates and the various incentives that have been provided. So commercial is also doing well. I must also mention, in addition to what I talked about, low interest rates and stamp duty and state incentives, that the center has also done a lot for the housing sector. For example, there is the credit-linked subsidy scheme, or what we call a CLSS scheme, under which if you're a first-time home buyer and you satisfy certain conditions, then there is an upfront amount that is paid by the government, which goes towards reducing your loan. Then in addition to that is the demographics in India. 2/3 of India's population is below 35 years of age. And the average age of a first-time home buyer is about 38 or 39 years. So there is a very large proportion of India's population which today is not even thought of buying a house. But over the next few years, all these younger people will get to an age where they will necessarily have to buy a house. So therefore, my sense is that the demand for housing in India is very, very structural in nature. It might be a little slow in some quarter or the other, but structurally, if you look at a 3-year view or a 5-year view, I would expect the growth to remain buoyant. I would expect the growth to remain strong.
Right. Loans under moratorium, Keki, for developer loans portfolio have only declined gradually, as we understand. At a sector level, do you expect restructuring to be higher for developer loans? And could this pose some sort of concerns on the NPA front?
All right. So I think, again, I'm talking of the sector. I'm not talking with specific reference to any particular lender or HDFC. The concerns on the real estate sector, on the construction finance sector, have been there for a very long time. For a long time now. We still have to wait for a quarter or two to say with certainty that things have now really got going and everything is hunky-dory. Having said that, the positive is that the demand for real estate is picking up. People are starting to buy properties, even if these are properties which are under construction, because the developers are offering discounts in a customer buying a property which is under construction. So cash flow to developers today is much better than what it was 3 months ago. That is the positive. Now, hopefully, if that strength sustains and continues for a while, which hopefully I would think it will, then a lot of the concerns around the developer lending for the sector as a whole should probably come off or reduce over the next couple of quarters.
You mentioned that demand has been broad-based. It's seen that demand from tier 2 as well as tier 3 cities, mainly the affordable segment as well, continues to be high. If you could just break up the trends that you're witnessing on ground for us.
So if we now I'm talking with specific reference to HDFC. If we were to look at a year ago, our average loan size for a new loan that we would have given to an individual would have been about 27 lakh rupees. Today, as in for the quarter ended September, our average loan was 26 lakh and 70,000 rupees. So roughly 30,000 rupees less than what it was a year ago. Not significantly different, but a little less than what it was a year ago. Normally, one would expect that year after year, the average loan would increase by 30,000 rupees, maybe a little more in a year, to keep pace with increase in incomes. But what has happened in the current year is that because of the pandemic, many companies have not given bonuses or have restricted the amount of bonus they gave to what it was in the previous year. Some cases salaries have been cut, in many cases salaries have not been increased. So therefore the average loan amount is slightly lower than what it was. Fortunately, job losses have not been even remotely close to what was being expected in April and May, when everyone was so worried that there would be massive job losses and there would be massive salary cuts and things like that. So we've not seen that. We've not seen that many job losses. Yes, salary cuts are there for people, but again, it's not that significant. And why in the housing finance business, asset quality remains robust or reasonably robust is because, one, the average loan to value ratio at the time of granting the loan is very low. At the time of granting the loan, for most players, the average loan to value ratio is below 70%, typically between 65 and 70%. So there is a huge amount of equity that the individual has in the property upfront. Secondly, in India, unlike what you see in the West, every single loan is repaid through equal monthly installments, which has a principal component. So with every passing month, the outstanding amount of the loan keeps declining. And because the outstanding amount of the loan keeps declining, automatically the loan to value ratio will also keep shrinking because the loan amount keeps reducing with every passing month. And therefore, the individual's equity in the property keeps rising. And therefore, if one is to foreclose the loan, which one would do in extreme cases. Then in almost every case, you'd get back your principal and interest and everything else. And also, housing loans are usually given to husband-wife together. So there are co-borrowers. So in the event one of the individuals is facing some difficulty with their job, the other person can take on the mantle of servicing the loan. So that is the reason why housing loans probably becomes one of the safest form of lending that you can do to individuals.
All right, Mr. Mistry, thanks so much for joining us this morning.